final video on inventory systems, we are going to focus on the year-end procedures for the periodic stock system. At the end of the financial year, the books need to be closed off in order for the business to determine its financial results and its financial position. Financial results is, we think, income statement. Financial position, we think, balance sheet. This needs to be done by both businesses using the perpetual inventory system and those using the periodic inventory system. The following accounts need to be drawn up at the end of the financial year: the trading account as well as the profit and loss account. In the periodic inventory system, the trading account differs quite significantly from that of a business using the perpetual inventory system. The profit and loss account remains, however, the same as for a business using the perpetual inventory system, except that there is no trading stock deficit account. So let's focus on the closing transfers. The closing transfers relating to the trading stock, opening stock, closing stock, and trading accounts. The trading stock account is used to hold the value of the opening stock for the accounting period. This is closing stock amount of the previous year. So we have our balance brought down, which is our opening stock. So at the end of the year, the sales account is closed off to the trading account. That's basically what we are used to. So we would have a sales account with a credit balance as it's an income account. We will therefore debit sales and credit the trading account. Therefore, sales is the contra entry on the credit side of our trading account. The balance brought down on the debit side of the trading stock account is transferred to the opening stock account. So we get rid of this trading stock account at the end of the year, and we credit it therefore, and then debit our opening stock account with trading stock on the debit side of the opening stock as our contra entry, as that's the account that was credited. So please take note, during the year there's no movement at all in trading stock. Remember, our movements take place in the purchases account. For the whole year we have this opening balance, and then only at the end of the year we get rid of that account by transferring it to our opening stock account. This amount is then transferred immediately to the trading account, so it's kind of a dummy account. Goes to the opening stock we close off, we therefore credit opening stock and debit our trading account. Therefore, in opening stock account, trading account is contra, as that is the account that will be debited. And in the trading account, the opening stock on the debit side is the contra account, as opening stock is credited. The stock take is done to determine the value of the closing stock. This amount is entered in the trading stock account and the closing stock account. So we have now the closing stock after the stock take. So we therefore credit our closing stock account. We debit trading stock. These are contra entries to each other. This amount is then transferred immediately to the trading account, similar as the opening stock account. So to get rid of the closing stock, we have to debit closing stock and therefore credit trading account. So the contra entry in trading account is closing stock, as that's the account that's debited. In closing stock, the contra entry is trading account. So the purchases, carriage on purchases and custom duty accounts are closed off as well to the trading account. So remember, purchase is an expense account. It has a debit balance. We will credit it to get rid of it and therefore debited trading account. Similar thing with carriage on purchase, expense account, debit balance. We will credit it to get rid of it, and trading account will be the contra entry. Therefore we debit trading account. Carriage on purchase is in the trading account of contra entry, as we would have credited carriage on purchase. Similar thing with customs duty. It works exactly the same as carriage on purchases. And then the trading account is closed off to the profit and loss account. So hopefully, usually our credit side is bigger than our debit side if we make a profit. Therefore, we will still need an amount to debit to close off this account. We will credit the profit and loss account. So that's the contra entry. The following steps must be followed when doing closing transfers to the trading account. As usual, no matter what system, we close off first the debtors allowances, which we know as a debit balance, so we will have to credit debtors allowances and debit sales to decrease sales. Then we need to transfer the balance in the trading stock account to the opening stock account. We close off the opening stock account, the purchases, the carriage on purchases, and the custom duties accounts to the trading account. All of these accounts in fact have debit balances. We credit it and debit the trading account. Then we enter the closing stock amount into the trading stock account on the debit side. Contra entry is the closing stock account, which we will credit. And then immediately afterwards we have to close off the sales as well as the closing stock to the trading account. We will debit therefore sales, debit the closing stock account, and credit our trading account. And then we can calculate the gross profit and transfer to the profit and loss account. So this is just a different way of setting out what we did in the previous slide. So let's illustrate by way of an example. We have Matsubula stores that uses the periodic stock system of stock control. The stock take revealed that there was 15,000 stock on hand, our closing stock. We have to extract from the post-adjustment trial balance after we made our adjustments on 30 November 2019. So we see we have a trading stock, the opening stock, debit balance. It makes sense, it's an asset. In our nominal accounts we have sales, yes, income as a credit balance. Then we have our expense accounts as purchases, debtors allowances, carriage on purchase, and custom duty, which all therefore should have debit balances as expenses increase on the debit side. We are required to draw up the trading account in the general ledger of Matsubula stores. So we should by now already visualize our structure for our trading account. On the credit side, we have our sales and our closing stock. On the debit side, we have our opening stock. carriage on purchases, customs duty, all of that. So we have on the credit side as indicated sales, but remember we first have to subtract the debtors allowances. So that's our first closing transfer. So it's the 143,540 minus the debtors allowance of 1,200. Then we have our opening stock on the debit side, the 25,000 Rand. We have our purchases of 1,000. So in fact all these expenses will be on the debit side, the carriage on purchases of 600 and the custom duties of 450. And then we have a stock take of 15,000. Remember that's the closing stock. It will be on the credit side. And then hopefully we have more on the credit than the debit side. Then we still need something on the debit side, and that would go to the profit and loss account. So the thing is, if you compare this with the perpetual inventory system, the one we are used to, we know we have on the credit side only sales. On the debit side we have cost of sales. So now in fact cost of sales just have a different structure. It's opening stock plus purchases plus carriage on purchases plus customs duty minus closing stock. That will give us in fact our cost of sales. So in a sense we have sales on the credit side and cost of sales on the debit side. Only thing is cost of sales on the debit side consists out of opening stock, purchases, carriage on purchases, customs duty, all of that added together and subtracting closing stock. So speaking of, let's illustrate it here. Remember that the cost of sales is the cost of the goods that were sold. In the periodic inventory system, the cost of sales may be calculated as follows. It is equal to the opening stock, the debit side of the trading account, plus the cost of the stock acquired minus closing stock, where cost of stock acquired is our purchases plus carriage on purchases plus customs duty. All of those entries we had in the trading account on the debit side. So it was opening stock on the debit side plus purchases plus carriage on purchases plus customs duty on the debit side. Then we subtract the closing stock which is on the credit side. Using the information from the previous example, we can calculate the cost of sales as follows. So we have at the opening stock of 25,000, we added the purchases of 54,100, the carriage on purchases of 600, the customs duty of 450. We add it up to get a subtotal, and then we subtract that closing stock according to the physical stock taking of 15,000. And we will obtain 65,150 as our cost of sales. So finally, we are going to focus on how to determine the average profit markup. Since all goods are marked up differently, the business can only determine the profit markup achieved, the average profit markup, at the end of the year after a stock take. This will be compared with the projected profit markup, in other words our estimate, in order to determine if any stock losses occurred. The following formula is used in order to determine the average profit markup. So the average profit markup in equation form is the gross profit divided by the cost of sales times 100 by 1. So using the values from the previous example, we can calculate the average profit markup as follows. So the gross profit we had was 77,190 and the cost of sales 65,150. We multiply by 100 over 1 to obtain a percentage of 118.5%. If the projected markup was 120%, then stock losses would have occurred because 118.5 is a bit less than the 120%.